All right, let's do this. So in this session, we're going to be talking about the topic of whether or not Bitcoin can be considered to be a store of value. Let's get started. First thing I think we should actually ask is whether or not this question makes sense in the first place. It's certainly a question that some people from time to time ask when considering Bitcoin as something which they may wish to acquire. And from some perspectives, the question itself is as irrelevant or as ridiculous as asking whether a piece of string is long or short. Because of course, these questions are really entirely subjective and entirely relative. So from one person's perspective, a short piece of string could be very long, and from another person's perspective, a long piece of string could actually be very short. And so you could have, various people looking up at the moon and asking and debating whether the moon is big or small. And I think there are many examples of this where the question itself is actually one that is rather irrelevant, but nevertheless still commonly asked. And the reason for that is that people in many cases, depending upon their educational background or upbringing, like certain definitions to apply and like the concept of an absolute certainty applying to a particular thing. A related concept, by the way, to this conversation is the question, is Bitcoin a currency? And again, the response is really, does the question make sense in the first place? Because the answer, of course, is dependent upon your definition of currency. And just as whether or not there's no definition of whether something is long or short, or no one definition of whether something is a currency, there's also no definition of what a perfect or immutable store of value is. So really the bigger question that we should be considering is, does it even matter? Why are we asking these questions in the first place? And in the vast majority of cases, a person who's asking this question, particularly in the concept of Bitcoin, is really a person who's trying to figure out whether or not Bitcoin would be a good investment or have some other type of utility to them. That's the reality as to why they are really asking this question. And what I think we need to focus on really here is the importance of what we call substance over form. So really, it's in some ways irrelevant how something looks like, but rather what is irrelevant is what it is. So, whether you label, for example, a piece of fruit, a banana or an apple, or any other name you wish to give to it, what you actually are probably trying to figure out is how it tastes or how healthy it is. Let's say a new vehicle is invented, and you could have lots of arguments about whether it's a bike or a scooter or an electric vehicle or a plane or a ship, and any other multitude of wording that you could apply to it. But it's really irrelevant. The real relevance is, what is the purpose of this vehicle and what does it achieve? We also see this very commonly in the area of racial and other types of prejudicial behavior, where people like to label a person with something, be it this person is black, or this person comes from this country, this person is Chinese. And really all these labels are irrelevant to probably in most cases what you're really trying to find out, which is this a good or a bad person? Does this person speak a particular language? What level of education does this person have? These are really the true questions that you need to be asking. So again, it's a natural human behavior often to try and apply labels and to believe that you can deduce certain conclusions from those labels that you've applied. But really what we should be doing as intelligent beings is looking at the actual conclusion that we are trying to get to, which is not always something that can be easily derived from or obtained from the simple application of a label. Let's now consider the relationship between volatility and preservation of value, because this is really, I think, what comes down to the crux of it for a lot of people when they consider a particular asset and its ability to serve a particular need which they have, which might be to preserve wealth. Let's take a property as an example, a residential property, and then compare that to a property-related stock. Most people, elderly people, and maybe all people, well, not all people, but certainly a lot of people would tell you that property is a good store of value. You could also use gold. You could use a lot of things. You could use a painting. Maybe you could use a blue chip stock. One of the reasons why people think that certain things are good stores of value is that they aren't immediately evaluated on a daily basis or on a second-by-second basis in the marketplace. So, if you have a property, you'll typically maybe get an assessment of its value once a month, once a year, and so you won't notice short-term volatile movements in that asset price. However, if property becomes valued down to the second, which it will over time for various reasons, you will perceive a far greater degree of volatility in that property. And so in a property's journey over a year, let's say, of appreciating 4%, if you were to look at its volatility on a daily basis, you could well see swings well above 4% or below 4%. So if you can imagine on a long period, a very, very straight, almost linear movement on a yearly basis between a property's value from the beginning of the year to the end. But of course, if you plotted it down to a daily basis or a per minute basis, you would see lots of ups and downs. And that's one reason why, by the way, that people have this perception about property. And now, if you compare this to, let's say, a currency or a stock, again, people might think that stocks or a portfolio of stocks are very, very volatile. But if you, the longer that you progress outwards, you would see that really there's a very long and consistent trend in the stock market, and it's upwards over time. And so applying this to Bitcoin, one commonly heard phrase that Bitcoin is used to people who have fears or perhaps misunderstand and confuse a long-term trend with volatility is these two words, zoom out. And you'll find that the more that you zoom out, and this doesn't have to be with Bitcoin, it's a whole range of assets, the more that volatility becomes less noticeable. Okay, so there is an important balance between the two, and we need to really clearly understand that all things have some degree of volatility. Even the most constant thing that you think is stable, such as a piece of gold, people will tell you gold bugs. Piece of gold is always a piece of gold. Well, actually, that's not true. A piece of gold consists of billions and billions and billions of molecules all moving. So on a molecular level, gold is itself also not stable. But again, really that lack of stability is unnoticeable for most people on a typical time frame that we would use. So it's really, to some extent, an illusion of the constant value compared to the dimension of time. And this is where the confusion sets in for a lot of people. If you were to have a very clear view, or quite a certain view, or even a view that it was more likely than not that the journey of Bitcoin over the next 20 years is more likely to be upwards rather than downwards in terms of value measured in another currency, then it would be a good decision for you to allocate some amount of that other currency to Bitcoin. The problem is that you would need to wait for that full period of time, and you would need to understand, obviously, that there would be ups and downs along the way. But if you were prepared to hold, or hodl as Bitcoiners say, then you would obviously make a gain in the long term over the other asset that you were using to put into Bitcoin, provided, of course, that Bitcoin did have that longer term upward journey. So again, Bitcoin in such a case would not only be a store of value, rather it would be outperforming as a store of value and indeed be a creator of value. Let's now consider the irony of cash being used as a store of value. Some of the most conservative people of all will tell you, oh, I don't buy stocks, or I don't buy property, I keep my money in cash. And of course, that happens to a lot of elderly people. It could be people that are not financially educated. It could be people that have had a bad experience with the particular asset class. That's probably most common. And the irony of this, of course, is that cash, we know for certain, is a declining store of value. There may not be a huge amount of volatility in that decline, particularly for people who measure their store of value in cash. To them, $1,000 will always be $1,000. But the irony, of course, is that the purchasing power, which is what we really care about, is declining over time due to that money being printed. So this is ironic, and it's something that's very important in the financial space and in the areas of psychology and economics that we really help people understand. And this is really also something that an investment advisor needs to carefully explain to their clients. It's the understanding, again, between volatility in the short term and a long-term trend. So fiat currency is definitely not a store of value, or at least not a perfect store of value. It will store on a diminishing basis value which is lost over time, just like a chargeable battery. Chargeable battery is by no means a perfect store of electricity, but it stably but surely declines to zero over time. And this is the case with fiat currency as well. Is volatility a bad thing? People often talk about volatility as though it is a bad thing, and it really all comes down to what you're trying to achieve. It really all depends. If you wanted to hold something as an intermediate currency in order to transfer wealth from one form into another, let's say you were in the US and you wanted to find a way to transfer that currency to another country. Let's say you wanted to do to Philippine pesos. And so you transferred that into Bitcoin as the intermediary currency and then transferred it over into Philippine pesos. Well, if there was volatility, that might not be the best medium to use, because in that short period of time in which you converted them to Bitcoin and then into pesos, you may have lost 10% of the value of that you were trying to store, or you may have gained 10%. So it really, again, all depends on your intended use purpose. In some areas of finance and investing, volatility can be a great thing. So if, for example, you are an investor in the Hong Kong property market, volatility is great, provided you get your timing right. If you in Hong Kong typically buy after a very large correction, so volatility on the downside, you will always have made a lot of money in the long term, because volatility is a two-way thing, and so there's also upside. So for the right person with the right mentality, the sort of person that is prepared to acquire an asset when there is blood on the streets or overwhelming negative sentiment, this is when volatility can really be your friend. Of course, this is not the case for a lot of people. It requires the right mindset and it requires confidence. If you are a person who, for various reasons, is inclined to buy things at the height of the market, be they certain types of stocks, be they property, or any other kind of hot asset, be it Tesla, as an example, not wanting to offend people who own Tesla, but the point is anything that's overly hot and in a historical asset class which is volatile, clearly if you buy it then, particularly if you don't have a long-term perspective or the right mindset from the outset, then it's probably not a great thing for what you're hoping for. So let's now talk about the role of cost averaging and portfolio allocation. I recently came across someone who noted something such as, if they had allocated 10% of their portfolio to Bitcoin at the height of the market when it was, say, 60,000 US per coin, they would have lost 5% of their value, the total value, in a very short period of time as Bitcoin fell from 60,000 down to 30,000. And that obviously for this person would not be a pleasant thing because they don't like short-term movements of this type, and it wasn't the type of loss that they had been willing to take for this type of asset. What does a person do if they believe that there is a long-term trend that is likely for an asset, or that there are black swan scenarios whereby they really would benefit from exposure to an asset, and so they do want some asset, they don't want a zero allocation, but they're worried about getting into the market due to the volatility of that asset? The best approach there, and a way that can help reduce volatility as well as also reduce the psychological impact of the negative feelings that come from volatility, are what we refer to as cost averaging. And quite simply, this involves purchasing a particular asset over a period of time up until the point that you reach your particular desired portfolio allocation. So let's take again the person who had lost 50% of their 10% allocation to Bitcoin, which they were unfortunate enough to have purchased exactly at the peak of the market. A number of things they could have done here. First of all, instead of purchasing 10% of their value in portfolio value in Bitcoin, they could have purchased 5%. And just in doing that, reducing their overall allocation, a 50% reduction of that 5% would have resulted them in losing 2.5% of their value. And that is to assume, of course, that the rest of the portfolio didn't rise. Bitcoin, being a non-correlated asset to other types of assets, may have meant that whilst the Bitcoin fell, other parts of that portfolio actually rose. So rather than being a 2.5% loss, the overall portfolio may have actually been up or flat. Let's now take it a step further. Instead of just buying 5% of a person's portfolio in Bitcoin, they may have decided to split that 50% to gold and 50% to Bitcoin. So there, they now only have a 2.5% allocation to Bitcoin, and of that 2.5%, a 50% fall in that would be a 1.25 decline in portfolio value. So again, there are two concepts here. The first one is portfolio allocation. Obviously, no matter what asset you want exposure to, the smaller amount that you get exposure to, the smaller amount your loss or your gain will be. The second is the period of time over which you buy in. Let's take a very simple example. If a person had put 5% of their net worth into Bitcoin at the very peak at 60,000, and there was a 50% loss, down to 30,000, that would be a 50% loss. Let's say they'd allocated it in just over in two payments, half of the amount going in at 60,000 and half going in at 30,000, and there was a drop to 30,000. There, all of a sudden, the loss is not one from 60,000 to 30,000, but rather their average purchasing price is 45,000. So as you can see, the more that you spread out your purchasing cost as you enter into a new asset, the more you even out your downside in the event that the asset declines in a short period of time. Of course, you're also evening out the upside. Now, there's been some great research in this area, particularly in relation to stocks. And someone like Warren Buffett, interestingly, is not a great fan of dollar cost averaging. From his perspective, if you find a stock that you want and you believe it's fair value, then you're better off buying it all at once, because all you're doing by not purchasing it, by spreading out those purchases, is that you are losing opportunity to capture future value over time, because he makes the assumption that he's already buying something at value, and therefore there's a greater likelihood of it going up over time as opposed to going down, even though of course he can't predict short-term volatility. So Buffett's view on an asset that he wants to acquire is acquire it now and don't bother playing the dollar cost averaging game. And I agree with that. And economics and stock trends all confirm that. However, for people who need who need the psychological support of not seeing sharp-term movements, or again for people who are entering a very volatile asset class, one where its intrinsic value cannot be well measured, such as Bitcoin or gold, as opposed to stocks or property, there you really might want to dollar cost average your way in as a way of smoothing out your entry point. Okay, so bottom line on what I want to leave people with is that the concept of value preservation is a relative concept compared to, which needs to be compared on a continuum of time. And secondly, that if you do want to be buying into an asset which you believe has long-term upside, but you are fearful of short-term volatility, the solution is to cost average in your allocation to that particular asset over time until you reach your desired portfolio allocation. All right, that's it. I hope that's been helpful.